What if everything you've ever been taught about investing, every stock tip, flashy financial app, breaking news headline, and expert prediction wasn't actually designed to make you rich, but to enrich someone else? What if the true path to wealth didn't require beating the market, but simply joining it? No secrets, no shortcuts. Just quiet, steady participation in the one system that has proven to create wealth for millions over decades. That's the promise of the Little Book of Common Sense Investing by John C. Bogle, the man who defied Wall Street's noise, challenged its profit model, and gave ordinary people a way to invest with power, purpose, and peace of mind. In the pages of this short but transformative book, Bogle lays out a simple truth. The more you try to outsmart the market, the more you likely underperform it. But if you embrace the wisdom of long-term, low-cost, diversified investing, you tilt the odds massively in your favor. In this audiobook, we'll explore that truth, not by summarizing all 18 chapters one by one, but by organizing the book's wisdom into 5 powerful themes. This isn't a typical chapter-by-chapter breakdown. Instead, we're focusing on the ideas that matter most, the ones that will stay with you long after the video ends. By taking this thematic approach, we keep the experience smooth, engaging, and easy to follow. No fragmentation.
No repetition.
Just the essence of Bogle's lifetime of financial wisdom, distilled for clarity and impact. You'll hear each concept not in isolation, but in context, with stories, examples, and transitions that make everything click. Think of it as a journey, not a checklist. Now, who is John C. Bogle, and why should his voice still matter in a world of robo-advisors, meme stocks, and real-time market data? Bogle wasn't just a financial writer. He was a revolutionary. As the founder of Vanguard, he introduced the world's first index mutual fund in 1976. It was an act of radical simplicity in a world addicted to complexity. Instead of paying high fees to experts who tried to pick winning stocks, Bogle asked a different question. What if we just bought the whole market? Not a piece, not a prediction, the entire market, and then held it for years, decades even. The response from Wall Street was ridicule. They mocked him, called his idea Bogle's folly. But Bogle didn't waver, because he wasn't trying to impress the experts, he was trying to empower the investor. Today, the very concept that was once considered foolish, index investing, is a cornerstone of modern finance. Trillions of dollars are now parked in low-cost index funds, and millions of everyday people have built lasting wealth not by being clever, but by being consistent. Bogle made it possible, and in doing so, he saved investors untold billions in fees, taxes, and bad decisions. But this book isn't just about what to invest in, it's about how to think about investing. And that mindset shift is what truly sets Bogle apart. While others sold strategies, he taught principles. While others promised secrets, he offered sense. And that's why this book, despite its size, holds so much power. If you stay with this audiobook summary, you'll learn why most investors underperform the very market they're trying to beat, and how you can avoid that trap. You'll see how fees, taxes, and high turnover silently erode your wealth, even when your portfolio looks like it's growing. You'll understand why simplicity beats complexity, and how doing less, but doing it well, can lead to superior results. You'll learn what most mutual fund managers don't want you to know, and why the financial industry often profits more from your activity than your success. Most of all, you'll come away with a deep sense of confidence, grounded not in prediction, but in evidence. Today's financial world is noisier than ever. Social media pushes market opinions in real time. Everyone's a guru. Everyone has a strategy. Everyone wants you to act now, click here, invest fast. But Bogle's voice cuts through all of it. He reminds us of something timeless, that the best investing decisions are often the most boring. That wealth isn't built by chasing alpha or timing markets. It's built by owning markets, minimizing costs, and staying the course. It's not glamorous. It's not thrilling, but it's real, and it works. This is why we've chosen to present this summary not as a bullet point list, but as a story with depth. Because this isn't just about numbers. It's about freedom. The freedom to retire comfortably. The freedom to stop worrying. The freedom to take back control of your financial life. And that journey begins right here. You won't need a financial background to understand what comes next. You don't need to memorize stock symbols or economic forecasts. You simply need to listen, reflect, and apply. So take a breath.
Clear your mind,
and prepare to unlearn some of the myths that have been holding you back. Because what you're about to hear is not just investing advice. It's a philosophy, one that has changed lives, built legacies, and empowered generations. It's time to hear the truth behind the market noise. It's time to learn how real wealth is built, not through hype, not through hustle, but through common sense. Let's begin. Coming up, the first core idea, why trying to beat the market is a rigged game, and why the smartest move you can make is to stop playing it. Chapter 1. The case for indexing. If you had to choose between guaranteed average returns or a small chance at beating the market with a very real risk of underperforming it, what would you choose? Most investors, whether out of pride, hope, or persuasion, chase the latter. They try to beat the market. They follow financial news, jump into new funds, chase hot stocks, or rely on advisors and managers who claim to know something others don't. But here's the uncomfortable truth that John Bogle lays bare. Most of them lose. Not dramatically, not right away, but quietly,
Steadily.
year after year. Their returns are chipped away by fees, taxes, poor timing, and a fundamental misunderstanding of how markets really work. Meanwhile, the market itself, the very thing they're trying to outperform, keeps growing,
Keeps compounding.
keeps delivering solid, reliable returns to those who simply stay in it. That's the core argument Bogle makes. Stop trying to beat the market and start owning it. Let's unpack what that means. When you invest in the stock market, you're essentially buying small pieces of real businesses, companies that produce value, generate profits, employ people, and drive economic growth. Over the long term, the stock market reflects the collective performance of those businesses. And historically, despite all the short-term noise, the long-term trend is unmistakable: up. From 1900 to the present day, the U.S. stock market has delivered an average annual return of around 9 to 10%. That includes the Great Depression, world wars, oil crises, bubbles, crashes, pandemics, you name it. Yet through all of that chaos, the market has rewarded those who stuck with it. Bogle's key insight is that trying to outperform this natural growth curve is not just difficult, it's counterproductive. For every winner in the market, there must be a loser. And when you account for trading fees, management costs, and taxes, the vast majority of active investors fall behind. This is where index funds come in. An index fund doesn't try to beat the market. It doesn't pick stocks. It doesn't trade in and out. It simply buys and holds all the stocks in a broad market index, like the S&P 500. That's it.
No predictions.
No strategy. Just silent, systematic ownership of a slice of the entire market. What's the result? Surprisingly powerful. Index funds outperform around 80 to 90% of actively managed mutual funds over long periods. Not because they're smarter, but because they're cheaper, more consistent, and immune to human error. They don't try to outthink the market. They simply mirror it. And in doing so, they remove the friction that erodes performance. This is where Bogle's genius shines through. He recognized that costs matter, and that they are the one variable investors can actually control. Let's say the stock market returns 8% annually. A typical mutual fund charges a 1% management fee. That's already 12.5% of your returns gone. Add in trading costs, turnover taxes, and other hidden fees, and you might be left with only 6% or less. That small difference, when compounded over decades, becomes enormous. Now imagine paying only 0.05% in fees, common in index funds today. That means you keep more of what the market gives you. And over time, that's what builds real wealth. Bogle called this the relentless rules of humble arithmetic. It's not sexy. It doesn't make headlines, but it works because the math doesn't lie. And there's another hidden advantage to index investing. It eliminates behavior-based losses. Studies show that most investors don't even get the full returns of the funds they invest in.
Why?
Because they jump in when markets are hot and pull out when they panic. They buy high and sell low. They react emotionally instead of staying disciplined. Index investing takes emotion out of the equation. It's boring by design. And in investing, boring is beautiful. Bogle was often criticized for promoting a strategy that seemed too simple. No flair, no timing, no genius involved. But that simplicity is the very reason it works. He often said, don't look for the needle in the haystack. Just buy the haystack. Stop trying to find the next Amazon or Tesla. Just own them all and let the winners pull you forward. There's also a powerful psychological shift that happens when you embrace this philosophy. You stop obsessing over the news. You stop second-guessing your portfolio. You stop comparing your performance to others. Instead, you develop calm, patience, a long-term view, and that mental state is just as valuable as the financial returns you gain. Now, is indexing perfect?
No strategy is.
You won't beat the market, but that's the point, because over the long run, you don't have to beat the market to build wealth. You just need to match it. And most people, by trying to do better, end up doing worse. Bogle didn't just offer a new investment tool. He offered a new worldview, a way to approach money, risk, and growth with humility. He reminded us that the markets are not a casino, and investing is not a game to be won. It's a tool for ownership, for discipline, for freedom. So the next time you hear a friend brag about their latest stock pick, or see a headline screaming about market volatility, remember Bogle's quiet revolution. Remember that the most powerful financial decision you can make isn't to be clever, but to be consistent. Because in the end, the real genius isn't in predicting markets, it's in trusting them. So, perhaps the most liberating lesson from Bogle's philosophy is this. You don't have to outsmart the market. You just have to stop getting in your own way. You don't need perfect timing or secret knowledge. What you need is trust in the system, in the process, and in the quiet power of ownership. But while many investors grasp that truth intellectually, they still fall behind, not because the market fails them, but because of the silent forces working against them. Because even when you do everything right, diversify, invest broadly, stay the course, there's still a thief at the table. One that eats into your returns slowly, invisibly, and persistently. That thief is cost. And if you're not careful, it will take more from you than any bear market ever could. Let's look closer at how fees, friction, and financial industry incentives quietly rob you of the future you're trying to build, often without you even realizing it. Chapter 2. The cost of investing. When most people think about losing money in the stock market, they picture a crash, a recession, a global event that wipes out wealth overnight. But in reality, the greatest threat to your financial future isn't dramatic. It's invisible. It doesn't make headlines. It doesn't trigger panic. It just chips away little by little year after year. That threat is cost. John Bogle believed that costs, management fees, transaction expenses, taxes, and advisory commissions are the single most overlooked danger to long-term investing success. They are small on the surface, almost harmless when viewed in isolation. But over time, these costs compound against you. They erode your returns in silence. And unlike market volatility, which eventually recovers, these costs are permanent. Once paid, they're gone forever. Let's break that down. Imagine you invest $10,000 for 30 years in a fund that earns 8% annually. If you paid no fees at all, your investment would grow to just over $100,000. But now, let's apply a seemingly harmless 2% annual cost, a combination of mutual fund management fees, advisor fees, and other hidden expenses. That same $10,000 now grows to only about $57,000. That's right, you've lost nearly half of your long-term gains to fees alone. Not to a stock market crash, not to inflation, but to a slow, quiet leak. This is what Bogle called the tyranny of compounding costs. Just as compounding can work powerfully for you, when your gains build on themselves, costs compound against you with equal force. And most investors don't even see it happening. Part of the problem is that the financial industry has done a masterful job of minimizing how these costs are presented. A 1% annual fee doesn't sound like much. It feels like a small price to pay for professional management or personalized advice. But over time, that 1% acts like a hole in the bottom of your wealth bucket. It doesn't drain you instantly. It just ensures that you never fill up. And fees aren't just about percentages, they reflect incentives. Bogle understood this better than anyone. He knew that the investment world is filled with products designed more for the benefit of the seller than the buyer. New mutual funds are launched constantly. Strategies are rebranded. Fund managers tout performance, hoping to attract assets and earn higher fees. But underneath it all, most of these products do not beat the market over time. They just cost more to own. He was blunt about it. In investing, you get what you don't pay for. The less you pay in costs, the more you keep. And keeping more over decades makes a profound difference. There's also the matter of taxes, another hidden cost that many investors underestimate. High turnover funds, those that frequently buy and sell stocks, trigger capital gains taxes every time they realize a profit. That means even if you don't sell your shares, you could still owe taxes on the fund's internal trades. This tax drag quietly reduces your after-tax return. Index funds, on the other hand, are incredibly tax efficient. Because they simply buy and hold a basket of stocks, they generate far fewer taxable events. In many cases, you can hold an index fund for years, sometimes decades, without incurring any capital gains tax until you decide to sell. This keeps more of your money working for you, rather than going to the government or back into someone else's bonus pool. And then there's turnover, the frequency with which funds trade their holdings. High turnover may seem like a sign of active management, of someone watching your money closely. But in practice, turnover is often just a sign of noise. It means more transaction costs, more taxes, more risk, and less consistency. The average actively managed mutual fund has a turnover rate of over 85%. The average index fund, often under 5%. Every extra trade is an opportunity for a mistake and a cost passed on to you. Bogle's message was clear. The fewer hands your money passes through, the better off you'll be. Now, It's not that all financial professionals are malicious or greedy. Many genuinely want to help, but the structure of the system creates a misalignment. Most managers and advisors are paid based on assets under management or transaction volume. That means their earnings grow not when you succeed, but when you invest more, trade more, and buy more products. It's a system that rewards activity, even when inactivity would serve you better. Index investing sidesteps that entire model. It minimizes costs, taxes, and turnover. It doesn't rely on predictions or sales pitches. It simply puts your money to work in the broad market and gets out of the way. Bogle once said that if a business charged you 2% a year to hold your money and returned you 6%, it would sound ridiculous. But in finance, that's considered normal. He believed that normal needed to be challenged and that investors had the right to demand better. And so he made it his life's mission to educate people about these hidden costs and to provide a low-cost alternative. Vanguard was born from that mission. And today, its impact is immeasurable. When you invest with cost in mind, something powerful happens. You become more patient, more deliberate, more focused. You no longer chase performance or jump from fund to fund. You stop reacting to market noise. You start to trust the process. And most importantly, you keep more of your gains, which means your future gets bigger, not smaller. The truth is, no one knows what the market will do next year or the year after. But the one thing you can be absolutely certain of every single year is how much you're paying. And that makes cost the most reliable predictor of your investing success. So ask yourself, are your investments working for you or for someone else? Because when you control your costs, you control your future. So ask yourself, are your investments quietly building your future or quietly draining it? Because when you understand how costs compound, you begin to see investing not as a gamble, but as a discipline. And when you choose low-cost, tax-efficient, no-nonsense strategies, you're not just making a financial decision, you're reclaiming control of your financial life. Still, even with the right investments and the lowest fees, there's a deeper force at work. One that can turn ordinary habits into extraordinary outcomes. One that requires no genius, no timing, and no prediction, only patience. It's the quiet partnership between time, compounding, and simplicity. And when these three come together, they become something more than a strategy. They become a philosophy,
a path,
a legacy. Let's explore that next. Chapter 3. Time, Compounding, and Simplicity. In the world of investing, there's a quiet truth that often gets overshadowed by headlines, market forecasts, and endless debates about strategy. Time is your greatest asset. Not timing, not tactics, just time. And when paired with the power of compounding and the clarity of simplicity, time becomes the foundation upon which real, lasting wealth is built. John Bogle understood this better than almost anyone. He knew that success in investing isn't about brilliance, it's about endurance. It's not about predicting the next big stock. It's about participating in long-term growth. It's not about reacting to every market swing. It's about participating in long-term growth. It's not about reacting to every market swing. It's about allowing time to do the heavy lifting. Let's begin with the most powerful yet misunderstood concept in personal finance: compound interest. Albert Einstein once called compounding the eighth wonder of the world. And for good reason. It's the quiet, invisible process by which your money earns returns, and then those returns earn more returns, and so on, over years and decades. Here's how it works. If you invest $10,000 at a 7% annual return, in 10 years it becomes nearly $20,000. But in 20 years, it becomes almost $40,000. And in 30 years, over $76,000. You didn't work harder for that growth. You didn't make brilliant investment choices. You simply gave your money time to multiply. This is where many investors go wrong. They underestimate the exponential nature of long-term growth. They get impatient. They interrupt the compounding process by pulling out early, reacting emotionally, or chasing new trends. In doing so, they reset the clock and sabotage the very engine of wealth. Bogle taught that the true magic of investing comes from doing less, not more. From staying the course, rather than constantly changing it. From trusting time, rather than trying to outweed it. That leads us to the second principle in this triad: simplicity. In an industry that thrives on complexity, where new financial products, acronyms, and exotic strategies emerge daily, Bogle stood alone in saying, the best investment plan is the simplest one. Buy a broadly diversified, low-cost index fund. Contribute to it regularly. Reinvest your dividends. And don't touch it for 20, 30, even 40 years. That's it. To many, that sounds too easy, too boring. But that's because simplicity doesn't sell. Complexity sounds smarter. It feels more exclusive. It gives the illusion of control. But in reality, complexity is often camouflage for inefficiency. It hides fees. It encourages tinkering. It appeals to ego. And worst of all, it distracts from the only thing that really matters, the growth of your wealth over time. Simplicity, on the other hand, keeps you grounded. It helps you avoid emotional decisions. It removes the temptation to jump in and out of the market. And most importantly, it aligns perfectly with the compounding process. Because compounding doesn't require brilliance, it requires consistency. Think of it this way. Every time you optimize your portfolio by chasing a new strategy, every time you try to time the market or chase a trend, you interrupt the very momentum that compounding depends on. Like stepping off a moving walkway, only to get back on later and wonder why you haven't made progress. That's why Bogle emphasized staying the course. He often said, time is your friend, impulse is your enemy. And no matter how smart or sophisticated you are, that truth applies. So, let's put this together. When you combine time, compounding, and simplicity, something remarkable happens. Investing becomes predictable, not in the sense that you know what will happen next week or next year, but in the sense that you can confidently expect growth over the long haul, as long as you don't get in your own way. This approach also gives you peace of mind. Instead of chasing performance, you focus on the process. Instead of stressing over markets, you focus on habits. You build your portfolio like a tree, planted deep, growing slowly, yet inevitably. Bogle wasn't promising that index investing would make you rich overnight. He was promising that if you gave it enough time, it would give you the best possible chance of reaching your goals with the least amount of stress, risk, and cost. And that message is more relevant today than ever. Because today's investor is bombarded with distractions, market apps with real-time tickers, 24-hour financial news, Reddit-fueled stock movements, crypto hype, and AI-driven trading strategies. Everything is urgent. Everything is now. But the market doesn't care about now. The market rewards those who stay. And when you stay, when you hold your investments through the ups and downs, through fear and greed, through recessions and recoveries, you tap into a force that no algorithm can replicate: compound trust. That trust is what allowed investors to stay invested during the 2008 financial crisis and emerge stronger. It's what helped those who stayed the course during the COVID crash recover within months. And it's what will carry you through whatever headlines dominate the next 5, 10, or 20 years. Time doesn't just grow your wealth. It grows your confidence. It deepens your understanding. It teaches you that markets rise and fall, but over the long term, discipline outperforms drama. So don't let simplicity fool you. It's not a sign of weakness. It's a sign of strength. The discipline to stick with something that works, even when everything around you tempts you to abandon it. And that's what this chapter is about. Not chasing more, but appreciating what you already have. The tools, the time, and the temperament to build lasting wealth. Because in the end, it's not the complexity of your portfolio that determines your outcome. It's the patience of your process. Now, we've seen how time and simplicity serve the long-term investor. But the financial world is full of distractions, strategies, products, and advisors all claiming to do better than the market. So how do we separate truth from salesmanship? That's where we're headed next, into the world of mutual funds, ETFs, and the seductive but dangerous habit of chasing performance. Chapter 4. Mutual funds, ETFs, and performance chasing. By now, it's clear that John Bogle advocated for a simple, low-cost, long-term approach to investing. But in a world saturated with financial products, each claiming to outperform the next, how do ordinary investors end up making decisions that seem smart, but actually cost them? It often starts with good intentions and bad information. The investment world is packed with choices: mutual funds, ETFs, hedge funds, private equity, actively managed portfolios, and robo-advisors. On the surface, it seems like a buffet of opportunity, but in reality, this overwhelming variety often leads to a familiar trap: performance chasing. Here's how it typically works. An investor sees that Fund X has outperformed the market for the past 3 years. It's been featured in magazines, praised by analysts, and maybe even recommended by a trusted advisor.
So they invest.
But over the next few years, the fund underperforms. Maybe the manager loses their edge, maybe market conditions shift, or maybe the fund just reverts to the mean. Either way, the investor gets frustrated and moves their money into the next high-performing fund. And so the cycle repeats. Bogle called this the performance derby, and he had one clear message: don't play it, because the data is sobering. Over the long term, most actively managed mutual funds do not beat the market. In fact, depending on the time frame, up to 80% to 90% of them underperform. And those that do outperform rarely do so consistently. Worse, the very act of jumping from one fund to another, especially based on short-term performance, leads to higher fees, tax consequences, emotional stress, and ultimately lower returns. Investors, in their effort to do better, often end up doing far worse. One of Bogle's most important insights is this: past performance does not predict future returns. It's written on every investment brochure and fund disclaimer, but most people ignore it.
Why?
Because we're wired to believe that trends continue. We assume that if a fund or a manager was successful in the past, they must know something, have an edge that will keep producing. But the truth is, markets are complex, dynamic, and driven by thousands of unpredictable variables. Skill is hard to isolate, and luck often masquerades as expertise. Even professional fund managers struggle. Bogle pointed to study after study showing that very few managers outperform their benchmark index over the long haul, and those who do are almost impossible to identify in advance. Meanwhile, index funds, which don't try to beat the market at all, consistently match the market's performance, minus minimal fees. No guessing, no manager turnover, no strategy drift. And yet, the allure of doing better remains strong. Which brings us to ETFs, exchange-traded funds. ETFs, like index funds, offer low-cost, diversified exposure to market segments. But unlike traditional index funds, ETFs can be traded throughout the day, just like stocks. That flexibility has made them popular, perhaps too popular, because with flexibility comes temptation. Many investors now use ETFs to speculate. They jump in and out, chasing sectors, themes, or short-term momentum. They treat ETFs not as long-term vehicles, but as tools for timing the market. This defeats the very purpose of index investing, which relies on patience, not performance chasing. Bogle respected ETFs as a structure, but he was wary of how they were used. In his words, what is being created is not an investment strategy, but a speculation strategy. And speculation, as Bogle repeatedly warned, is the enemy of investing. It's also important to understand the incentives behind the mutual fund industry. Fund companies make money by gathering assets and charging fees. That means they're constantly launching new funds, promoting recent winners, and encouraging rotation. Their goal is not necessarily your success. It's your continued participation. The more you buy, switch, and believe in the next hot thing, the more they win. That's why Bogle urged investors to be skeptical, not cynical, but cautious. Ask, who benefits from this recommendation? Whose pockets are being lined when I switch funds? What am I really gaining from this complexity? He argued that the simplest portfolio, often just one or two broad market index funds, outperforms not only most complex strategies, but also outperforms them with less risk, lower cost, and far more peace of mind. This philosophy isn't just about money, it's about behavior. Because over time, the biggest cost most investors face isn't fees or taxes. It's their own decisions. The impulse to chase returns, the urge to react, the fear of missing out. Index investing, when done properly, eliminates those impulses. It gives you a plan you can stick to. And that consistency is what builds wealth, not headlines, not market predictions, not the latest fund launch. So, what does this mean for you? It means that resisting the pull of performance chasing is not a weakness. It's a strength. It means that the smartest move you can make might be the least exciting one. It means that every time you choose simplicity over sophistication and discipline over drama, you take one step closer to real financial freedom. Because in the end, the winners of the investment game aren't the ones who make the most moves. They're the ones who make the fewest mistakes. And that brings us to Bogle's lasting legacy. Not just the creation of index funds or the founding of Vanguard, but the mindset he gave to millions. That you can succeed in investing not by doing more, but by doing what matters and sticking with it. Let's conclude with the timeless principles that Bogle left behind, and why they still matter now, more than ever. Chapter 5. Conclusion. The Legacy of Common Sense Investing. When John C. Bogle wrote The Little Book of Common Sense Investing, he wasn't introducing a trend. He was offering a compass. In a world that thrives on financial complexity, where products multiply, fees hide in fine print, and media headlines compete for your fear, Bogle's voice stood apart. Quiet, measured, and persistent. He didn't sell magic formulas. He didn't make bold predictions. He simply told the truth. The kind of truth that doesn't sparkle, but stands the test of time. And that truth is this. The winning investment strategy for most people is simple, boring, and remarkably effective. Own the entire market, keep your costs low, invest regularly, reinvest your dividends, and stay the course. It's not exciting. It's not headline-grabbing, but it works. Over the decades, Bogle's philosophy helped build Vanguard into one of the largest investment firms in the world. But perhaps his greatest legacy isn't measured in assets under management. It's measured in the millions of investors he empowered to take control of their financial future. Before Bogle, investing was often a game reserved for experts, insiders, and financial institutions. After Bogle, it became something the everyday person could navigate with confidence. He taught us that wealth isn't built through endless trading, market timing, or chasing the next big thing. It's built through discipline, patience, and trust. Trust in the market's long-term growth. Trust in the quiet power of compounding. Trust in yourself to stay the course, even when the noise around you demands action. His message is more important today than ever, because today, the noise is louder. Social media, apps, and real-time tickers scream for attention. You don't have to trust your money to expensive managers chasing performance. You don't have to outguess the market. You can build wealth by owning the market, plain and simple, because every dollar you keep in your pocket, instead of paying it out in fees, is a dollar that compounds for you. Every year you stay invested is a year the market works in your favor. And every time you choose simplicity over complexity, you choose peace of mind over stress. Bogle's philosophy isn't about beating the system. It's about not letting the system beat you. He understood that the financial industry as a whole profits from your activity, from your switching, your reacting, your chasing. The more you do, the more they earn. But you don't have to play by those rules. You can opt out. You can choose an index fund. You can build a simple portfolio. You can trust in time. And by doing that, you give yourself something rare: freedom. Freedom from worrying about the next market dip. Freedom from the pressure to time your investments perfectly. Freedom from the emotional roller coaster of watching daily stock movements. Freedom to focus on your life, your family, your goals. Bogle's legacy is more than index funds. It's an invitation to step away from the crowd, to resist the noise, and to embrace the quiet, powerful rhythm of long-term investing. It's an invitation to think less about performance and more about process, to think less about chasing gains and more about protecting your future, to stop asking, what's the best investment right now? And to start asking, what's the best investment for me for the next 30 years? Because wealth isn't built overnight. And it isn't built by being the smartest person in the room. It's built by being consistent, disciplined, and patient when others are not. If you remember nothing else from this book, remember this. Stay the course. Don't let short-term movements shake your confidence. Don't let financial headlines dictate your plan. Don't let complexity distract you from what works. Own the market, keep your costs low, hold your investments, and let time do the rest. This is the simple, powerful, life-changing message of John C. Bogle. And if you carry it with you through bull markets, bear markets, celebrations, and setbacks, you'll discover that common sense investing isn't just a financial strategy. It's a way to build freedom. It's a way to build peace of mind, and it's a way to build wealth that lasts. Thank you for listening. If you've found value in this journey, if the ideas of simplicity, patience, and common sense investing resonate with you, don't stop here. Subscribe to this channel for more audiobook summaries that break down the most powerful wealth-building strategies from some of the world's greatest financial thinkers. Each summary is crafted to save you time, sharpen your knowledge, and keep you focused on what truly works. If you want to build lasting wealth without getting lost in the noise, you are in the right place. And remember, what you've just learned is only powerful if you apply it.
Take action.
Start investing. Stay consistent. And most of all, stay in the course.